Welcome to this explainer. Whether you're living it up in Mumbai or working abroad in Dubai, navigating Indian tax laws can sometimes feel like, learning a completely second language. But today, I am incredibly excited to be your guide for a fast-paced explainer, breaking down a truly massive and surprisingly simple financial reform for Indian residents and global citizens alike. We're talking about a major shift in how you secure your family's future, a shift that's going to save a lot of people a very significant amount of money over the long haul. Did you know life insurance became cheaper in India from 22 September 2025? Seriously, it's absolutely true. The entire landscape of financial protection in India shifted on that exact date. And honestly, if you haven't reviewed your financial plan since then, you absolutely need to pay close attention to what we're covering today. We're going to unpack exactly how this changes the game for your wealth and your family's security. Okay, let's dive into Section 1, the Zero GST reform, where we're watching that 18% drop all the way down to zero. So to understand why your financial protection just got this massive upgrade, we have to look at the core mechanism of what the government actually did. Get this. The GST rate on eligible individual life insurance policies has been reduced from 18% to zero. For years, policyholders had to pay this kind of invisible 18% penalty right on top of their base premiums. I mean, imagine paying a hefty tax just to ensure your family doesn't go bankrupt if something tragic happens to you. When you stretch an 18% tax over a 20 or 30-year term policy, the cumulative drain on your wealth is literally staggering. By decisively wiping that out down to absolute zero, the government has totally lowered the barrier to protecting your family. That means buying or renewing an eligible individual life insurance policy is now more affordable. But hey, there is an incredibly important distinction we need to make right out of the gate. This 0% rate applies strictly to individual policies. Think of your personal term plans, your ULIPs, and your endowment policies that you purchase out of pocket. If you have a group term or an employee policy provided through your workplace, well, those still attract the old 18% tax. And that makes sense, right? Corporate policies are often subsidized by employers anyway, so this specific reform is a highly targeted win for your personal, individual coverage. Moving right along to Section 2, cheaper premiums, immediate savings. Let's look at putting real money back in your pocket. And this brilliantly illustrates exactly what we're talking about. Theories and percentages are great for economists, but we need to see what this looks like for your wallet. Let's run a quick scenario. If your annual base premium is 30,000 rupees, you were historically on the hook for 35,400 rupees in total because of that heavy 18% GST layer. Today, you just pay the flat 30,000. That's an annual savings of 5,400 rupees. Now, multiply that over a standard 20-year policy, and you're saving well over a lakh. This isn't some deferred benefit or complicated tax rebate that takes months to process. That is direct, tangible wealth staying in your family's control every single year, right from day one. All right, Section 3, a major win for NRIs, because global Indians definitely benefit here too. Now, to be super clear, this benefit isn't limited to NRIs. It applies to eligible individual policies generally. But for NRIs, this can be especially valuable if you have family members who depend on your income, or if you're reviewing your long-term financial and estate planning. Let's say you're an NRI software engineer living in Dubai, and you want to secure your parents' future back in Mumbai. A rupee-denominated policy provides immediate localized financial support for them, without the headache of international wire transfers or crazy volatile currency conversion fees during a medical or family emergency. Plus, the logistics have totally caught up with the reality of global living. You can now seamlessly pay these GST-free premiums using your NRE, NRO, or domestic savings accounts. It's streamlined, it keeps the funds localized, and it's incredibly efficient. Let's move to Section 4, tax deductions and exemptions. Let's see how this builds when we layer the financial value. Depending on your circumstances, eligible premiums may qualify for tax deductions under Section 80C. If you're filing your taxes under the old tax regime in India, you can claim up to 1.5 lakh rupees in annual deductions based on these premiums. You just need to keep in mind a quick rule of thumb here. To qualify for this deduction, your annual premium generally cannot exceed 10% of your total sum assured. When you combine this traditional deduction with the brand new 0% GST baseline, you're aggressively compounding the financial efficiency of your entire insurance strategy. And honestly, it gets even better at the payout stage. Policy proceeds may receive favorable treatment under Section 1010D, subject to the conditions in the Income Tax Act. Here is the critical detail that makes this so powerful. Unlike the ADC deductions we just talked about, this exemption on death benefits is fully available whether you use the old or the new tax regime. In a world where tax brackets are constantly shifting, knowing that the final payout to your family is shielded from taxation serves as a rock-solid pillar for preserving wealth across borders and across generations. Finally, Section 5, Smarter Protection, Better Planning. Let's talk about your next steps. So, the crucial point is knowing how to act on this information to properly secure your financial future. The landscape is now significantly cheaper and highly efficient, but you still need a concrete strategy. Before buying a policy, review your coverage needs, nomination details, and tax position. Do a thorough, honest review of what it actually costs to run your household. Make sure your coverage matches your family's real-world living expenses, inflation, and future liabilities, rather than just picking a random round number out of thin air. Double-check your nomination details to ensure they're up to date. That avoids massive legal hurdles for your loved ones down the line. And finally, sit down and assess whether the old or new tax regime makes the most sense for your specific income level, especially now that the GST factor is completely gone. Lower GST, smarter protection, better planning. The 18% tax block is officially a thing of the past for these individual policies, clearing the path for you to secure comprehensive, highly efficient coverage for the people you care about most. So I want to leave you with a question to chew on today. Knowing what you know now about these structural changes, are you leaving money on the table with your current financial plan? Thanks so much for joining me for this explainer, and I will catch you in the next one.